start with the president of Mauritius because she's quite, she's also Professor Dr. Amina Gurib-Fakim. Amina, the stage is yours now.
Thank you, Ben. I would like again to thank you for associating me with this very important discussion. And I understand that I'm to speak on the regulatory environment that will allow such initiative. But before speaking on this, let me first go back to why countries, especially those in Africa and the global south, could benefit from impact investment, and why it may be important to go down that route in order to help them grow in an era of a changing climate. Let me begin with Africa and why we need all the financial resources that can be made available for her to grow. Africa has contributed around 3% of greenhouse gas emission and yet is bearing the brunt of a changing climate. How to fix it, or rather how to live with it and adapt, means access to finance at scale. Africa is home to 1.4 billion people with a median age of 16 and heading to 2 billion by 2050. Yet, in her 60-plus years of post-independent history, the continent continues to suffer from stalling multilateral trade negotiations, and the death of the Doha Round has given rise to unprecedented forms of protectionism, unilateralism, a lack of political leadership to embrace and nurture multilateralism. Unfair competition, unilateral partition of Africa into Economic Partnership Agreement, EPAs, and skewed intellectual property rights have resulted in an international trade system that disproportionately favors wealthy economies. The emerging trade climate change measures will only further restrict Africa's participation in global trade markets. So to tackle the looming climate crisis, the question is as follows. Should Africa still depend on the generosity of the global north? Their inability to meet the 100 billion pledge revealed their moral reluctance to acknowledge developed countries' contribution to climate change. Yet, to transition to a greener future, Africa must access affordable public and private funding coupled with debt relief. Ladies and gentlemen, these shifts are central to building capacity for sustained transformative growth and resilience in the face of climate challenges. Developed countries have resisted fundamental reforms to support the developing world with climate emergency. Innovative global development finance ecosystems are needed to unlock equitable international financing flows while preserving the fiscal sovereignty of developing countries to pursue development pathways unique to their circumstances and realities. Africa's position is constrained by a lack of affordable, reliable, and sufficient finance, juxtaposed with a debt crisis compounded by climate challenges. At the level of the multilateral institutions as the IMF, the issuance and recycling of the SDRs, the special drawing rights, a means for enhancing available climate financing, is drawing global attention. IMF rechanneling of the idle SDRs should be used to help developing countries with much needed finance, fiscal sovereignty of African economies, but being the fact that the SDRs are weighted to the amount going to African and other poorer countries remain tiny. Ladies and gentlemen, there is a globally recognized need to shift, unlock, scale, and mobilize new forms of fit-for-purpose finance to deliver on climate agreements and sustainable development goals. The priority of priorities for African and, of course, global South countries is to have affordable, predictable, accessible finance at scale. This is where impact investing can help. Impact investing is gaining momentum, and yet globally, it remains subdued. And only 2% of the total global impact investment come from pension funds, and yet the market of impact investing is on the rise as people realize its potential to target social issues and environmental challenges. There are a few reasons leading to this such situation: limited information, lack of standardization in the measurement of the impact, and mainly fiduciary duty and risk management, as pension funds are traditionally risk averse. But as pension funds and sovereign wealth funds have long-term obligations and investment horizons, this put them into a unique position to contribute to the SDGs and take action on sustainability risk, especially climate change. More than half of the world's 100 largest public pension and sovereign wealth funds account for $22 trillion in assets under management and have long-term obligation and investment horizon. Yet, more than half of the world's 100 largest public pension and sovereign wealth funds do not disclose or report on sustainability issues, and institutional investors and as a group, they can do more to mainstream sustainability. Yet, limited number of funds publish meaningful reporting on their sustainability performance and ESG integration strategies. Sovereign wealth funds are also relatively less transparent than pension funds. Many reporting funds acknowledge the material risk posed by ESG issues and associated regulatory measures, with the majority of these funds changing their investment strategies and policies accordingly. Reporting funds are increasingly sensitive to climate-related risk, with more than 4 out of 5 funds having designed a climate or carbon dioxide reduction strategy, and the same number reporting the use of an international reporting framework on sustainability. Reporting funds are also defining climate-related targets for their investment decisions and sustainability integration strategies, with more than 2/3 of front-runner funds using a specific climate target, such as net zero. However, only 20% of funds are using audited or certification processes to evaluate their sustainability reporting and ESG integration. Yet, funds have identified pools of good practices for sustainability integration in strategic areas like governance, corporate sustainable investment policies, sustainability integration strategies, ESG integration along the investment chain, climate action, and evaluation reporting. There is a clear recognition that institutional investors with a long-term investment horizon, such as pension and sovereign wealth fund, need to pivot rapidly to a more sustainable investment portfolio. Such reorientation can mitigate a range of sustainability-related risks and help contribute to sustainable financing through, for example, investment in renewable energy or clean technology. While there is much good practice to be applauded and shared, there's also room for improvement, especially on disclosure and reporting, where there is great variance among reporting funds in terms of what and how to report. Meanwhile, the use of key performance indicators is lagging, making sustainability disclosure highly subjective in some cases. What is needed is greater harmonization of standards and regulations to promote more widespread action on sustainability integration and performance. Institutional investors need to integrate development objectives, especially the SDGs, into their investment. This will bring more credibility to their claim to be sustainable investors while helping them to mitigate relevant risk. Ladies and gentlemen, the SDGs provide a useful framework for sustainability integration and broaden the sustainable investment agenda. Impact investing is set to have the famous triple bottom line, whereby the social or environmental impact and the financial return have equal importance and reinforce each other. Correlation between impact investing and financial performance have been tested, demonstrating synergies across risk, return, and impact metrics, but transparency must remain key to sustain trust and confidence. I thank you for your attention.
Thank you, Amina. Ladies and gentlemen, Amina will have to leave soon, so if you have any questions for her, please ask now. I just wanted to jump ahead before anybody asks. I was thinking of what Dr. Greg Hainan will say, because he's also talking from the point of view of regulations on pension funds and everything. What would be your advice to the pension funds? Because I think one of the issues that Africa has is the perception and the regulation, which is, I think, stopping a lot of pension funds in the Western world to invest in Africa. So what would be your advice to the pension funds?
Unfortunately, Africa is not on the radar of many countries, of the powers which are at right now. And I think this is where there is a mistake, because I will posit this, because 40 years ago, the world didn't see China coming, and China came 40 years later. I think we're in a similar position now. We are ignoring Africa, much to the disadvantage of the rest of the world, because they are not seeing the potential that Africa presents in terms of development. And if we were to invest in development, there are so many areas, so many avenues where the returns will be, but of course in the long term, not immediate in the short term. And I think of agriculture being one of them. I think of energy. I think of so many other important thematics, which of course will have a direct impact on the population of Africa and of course of the world. And yet it is not being seen from that perspective, because so far the rest of the world has seen Africa only through the humanitarian lens, which is of course completely wrong. So what we need to do is look at ways of comforting those with the sovereign fund, with those, of course, the pension fund, but put in the framework where there is transparency, because I think the world has experienced too many bad examples to just give away the pension fund, of course, the employees like this. So they need more transparency, more regulatory approach. At the same time, also, KPI, how are they going to monitor what's going on with the investment? So I think if we put all these in place, I don't see why this cannot be an avenue for Africa to actually access funds at scale, because right now it has been a trickle down and it is not working.
This is fantastic. Thank you so much. And with this, we will give, please, the word to speakers we have here exactly who are heads of pension funds. Please.
Yeah, sorry. So I hear what you just said, but we need to walk before we run. And as you just said, allocations to impact investing is yet 2%, even less in Switzerland. Now, the whole constraint is to start a meaningful investment locally, to maybe have the experience, and then I think we'll get there. We'll get to Africa, we'll get to Asia, and so on. But we need to do this first step in locally. But then there are other constraints that we have to solve first, and regulation is one of them.
Yeah. Yeah.
Thank you very much. Just a comment on the great speech from Mauritius. One of the things that I think pension funds could consider is to look at those strong institutions that we see, for instance, in Africa. I can mention, some of the regional development banks. IFO, our institution, the Danish DFI, we have invested equity in the TDB bank, which is a development bank. It's profitable. It's very well managed. It has, as B shareholders, also African pension funds. So I think that just to allocate a bit of time in assessing institutions like TDB, like AFC, and others in other parts of the world where you have strong performance and you have a strong ability to manage risk because of the governance structure of these institutions, and hence you also receive stable returns. So an institution like TDB has, for the last 10 years, had a stable return on equity of about 12% in US dollars, and has been paying dividends to the B shareholders, including us, but also, of course, the African pension funds. Just a practical suggestion.
Yes, no, and I was thinking another practical suggestion, because I think many pension funds, they have this barrier of information. There is this consortium of multilateral development banks. They have put together all the infrastructure deals for the last 15 years in a database called GEMS. And there you can see that these deals are really not failing. I mean, they are really profitable and with very, very few casualties. So more information is needed, and this is one example what we can do to help this.
Thank you so much. Mr. Ogushe, please.
Thank you. Apologies, I couldn't be there with you in person. I would have loved to come to Geneva. But thank you for inviting me. I'm inspired by Imre Habsburger. I know they said he's the inspirer. I'm inspired by what he shared, and also by my father Finn. I'm actually inspired. I do find my last speech, also coming from Africa, I share his sentiments 100%. And just seeing how we need to get the taps open with Africa as opposed to the trickles. But I just want to introduce a different angle to this conversation, and that is on definition of impact. Right. And from where I sit in Africa, if I'm investing a bond in a company that is hiring more people, that is giving power to people, that is creating jobs, in my view, that's impact. So it's not until I invest in a green bond that I term it as impact, because in Africa and Nigeria specifically, where I come from, you have an unemployment rate of about 40%. Youth unemployment rate even higher than that. And we've got the largest energy poverty in the world, where people don't have access to energy. So if a pension fund is investing in a power plant that is giving power to more people, that is giving jobs to more people, that is lifting people out of poverty, that is impact. And already we are doing that. So I guess definition is a bit narrow, where we think it's just a green bond or it's just climate finance, and then it's impact. Then there's a lot of impact that pension funds are doing. We can do more. And that 2% is just, quite narrow in my view. The second thing I like to agree with a number of people on the panel is regarding information. One of the panelists, I can't remember who it was talking about information on, the companies they've invested in, especially the S, whereby they realize that those companies, when they invest in them, their returns are higher because they're focusing on, social good and things like that. So if pension funds are able to see this information and it's widespread, they will definitely act on it. Also, just perception of risk, is higher, and might not necessarily be the case. Like the previous speaker said, I think it was GEMS, whereby they've got a lot of information on infrastructure, and to show that, those are not failing. So that's what I like to add to the conversation, in addition to just deal flow, right? So, pension funds will argue that there is a moral hazard in, I'm investing, and I shouldn't be the one determining the transaction. So, they'll tell me most of the times that, bring the transactions on. So we are not seeing the deal flow of those transactions at scale, right? And I think that's one thing that we need to see how we can plug, especially with regards to project preparation, how we can prepare some of these projects, get them to a point where pension funds can invest in, risk mitigation tools where pension funds have more confidence because they know that there are backstops. So these are things, from my angle, I'd like to chip into discussion. A couple of other things, but I'll just pause here, and I'll share other thoughts later. Thank you.
Thank you. Thank you so much. So we'd like now the panelists here to develop your expertise regarding to impact investing in the pension funds, and what do you see for the future as concrete levers we could act upon to go from 2% to more. Thank you.
Whoever, yes?
Lady first.
Ladies first. Well, I come from the European Investment Bank, and maybe you know that the European Investment Bank is the bank of the European Union. It is in charge of putting or promoting or supporting the policy priorities of the European Commission, and it is owned by the member states. So from that perspective, we are a policy-driven bank, and saying this, we have been a purposeful investment partner from the very beginning. And if this can equate to impact, then we are an impact financier. I'm going to share with you a little bit the journey, why the EIB shifted into becoming the European Climate Bank only recently in year 2020. We have been for decades already working on climate, because already in 2007, when the Commission came forward with the 2020 package, we realized that the global warming was such a menace that whatever we do for the rest of developing or development priorities could be washed away by the impacts of climate change at any given moment. But not only for that, together with climate, you have a lot of co-benefits, be it pollution reduction, be biodiversity, be gender. So it is really a purpose that covers many other co-benefits. So when the Commission came forward in the year 2019 with the Green Deal, the bank, or the governors, the member states, took the decision of transforming the bank into a climate bank. And this was done taking, 4 main commitments. The first commitment was to lend. So of all our activities, 50% would go into climate and environmental sustainability. Then the second one would be to mobilize 1 trillion of investments from 2020 to 2030. And then the third commitment was to align all activities with Paris. And I will get back to what we decided and tell you where we are today, and more than where we are today, where we are struggling today. So for the 50% target, of course, it is a very huge target. Every year, the bank lends more or less 70 billion euros. So this year, 2022, we lent 37 billion to climate action. And year after year, you really have to find these projects, and it's becoming very, very work intensive. And you will see that we had to train all our front office, and we had to engage with clients, trying to find out of their investment programs what is climate, what is not climate, and try to support them in their transition to low carbon activity. So that is already quite a significant change for us. Then for Paris alignment, which was the second one, we decided what type of activities we couldn't support anymore. And one of them, starting in year 2019, was to leave out support to any fossil fuels immediately. So that, for example, outside the Union was not understood at all. And even inside the Union, the European Union, not all the member states have the same level of cohesion and the same level of development. So it was not understood either. So we had to do a lot of work to engage with clients and explain why we were going into this low carbon framework. And still today, we need to work on this on a daily basis. And then the third point on mobilization, this is where the critical part is for the pension industry. The European Investment Bank, the mandate of the European Investment Bank is to be a crowding institution. So we very rarely go into a project financing the whole project. Maximum we can finance 100%, with only few exceptions, like emergency recovery or this type of investments where we can go higher. So always we have to co-invest with third parties. We also do a lot of financial innovation, so to try to adjust the risk of the projects to the different risk-adjusted returns of the different clients that we may have. For instance, in year 2007, when the European Commission came with the 2020 package, the EIB was the first institution to ever launch or issue a green bond. So this is where our financial innovation comes forward. But the idea is that we are still very far from mobilizing what is needed. Nicoleta was explaining at the very beginning the huge gap that we have. Only in climate finance, we need to mobilize 3.5 trillion per year to meet the demand or the needs. And we are doing, 37 billion? So how many EIBs do we need? 100. So this is why we really need to mobilize pension funds. Nicoleta was also mentioning only 2% of the pension funds amount go into impact investment. Part of that would be climate investment. So for us, what I would say today here is I am supporter of having a target. Say, instead of 2%, put it at 5% or at 7%. For us, when we came with the target, we were, on one point, very challenged because we had to really reinvent the bank to become the climate bank, but also we were criticized because climate is not the only objective. You have also innovation objective, you have cohesion objective, poverty reduction, you have many other objectives that are very important. So I know it is not easy, but it is, a focus and a beacon, or I don't know how to say it, for setting the direction. I would very much suggest this target for pension industry.
Thank you, Esther. I was just going from this point to Greg. So Greg, like Esther mentioned, that EIB has a very clear vision, very clear directive on, for example, climate change. How do you look at it from the Swiss pension funds angle?
So I'd like to mention the outcome of COP26. COP26 was calling for redirecting flows into meaningful and scalable projects. Another outcome was to create public-private partnerships. And COP26 was calling for collective action. So that was our starting point. And we think the impact strategy should start with an engagement activity. So engage with policymakers, with corporates, but managers as well. So I'm a special advisor of the IIGCC, which is the largest activist group in Europe. And we've also engaged with auditors and with data providers, because we need quality data to take proper decisions. When it comes to funding the transition and climate change, we think we need a collective action, and we need to collaborate with governments. That's the concept that we want to put forward, because we want to think the whole cycle of the development of the solution, the production, the distribution, and the consumption. And we can only do that in a meaningful manner if we team up with the government and we syndicate investors. So one of the solutions, and why Africa is not yet a destination for flows, financial flows, is because we need first to syndicate investors and invest in a meaningful fashion.
And when you speak about syndicating, you're speaking only about pension funds in Switzerland, or also Denmark and other countries, and also institutions like EIB?
Well, we'll all need to find a collective solution. So we can do it locally, we can do it with also investors, but then we'll have to face regulation issues, we have to face fiscal issues. So these are a constraint that we'll have to solve before we can invest with international investors. The aim is to create a model that can be replicated elsewhere, but also, co-investing is the solution that we want to prioritize.
Thank you. And Motem, are you also considering thinking in the same line, or you guys are already doing it?
So at IFU, we are an impact investor. So when we look at an investment opportunity, we say it has to have impact. Then we look at the financial return. It also has to be a commercial investment. We are now raising a fund, we call it the SDG Equity Fund, trying to get Danish pension funds especially, but also other private investors on board. This is a fund that will invest in equity. We're seeking to raise about 700 million euros. It's going to be an Article 9 compliant fund. So we have over the years also worked hard to understand what is impact, how do we measure it, how do we document it. This fundraise that we are in the middle of now is based on the first SDG equity fund which we have invested, where we also had about a little less than 700 billion, of which 60% came from Danish pension funds. So we were in a quite privileged situation that the Danish pension funds were entrusting a lot of capital for us, maybe not a lot of their capital, but for us it was a lot of capital, and it was said here, you have to start small, even though 700 million euros is also a significant amount of money. We've managed to invest all this, and now we have also managed to exit a few investments. We had an investment in energy, renewable energy, a distributed energy company working out of Nigeria, where we not only created a lot of impact in terms of climate and helped the company scale, but we're also able to exit to a private investor for even more scale of the impact. So the public-private partnership is important to create the regulatory environments that would allow, for instance, on-grid power purchasing agreements that would help de-risk the investments. But there are also investment opportunities that we are looking at, which can be done under the given regulatory environment. Because we have to do both. We have to look at the regulatory environment, both as they pertain to the pension funds, institutional investors in our own markets, because looking at the global risk, it may be that we are not calculating the systemic risk in the right way with the regulations we have nowadays, but also, of course, the regulations in the markets that we are operating in, just as we are doing in our own countries, constantly trying to reform and having public-private engagement to understand, where is the common ground. So it's a collective effort at the global level, at the country level, at the regional level, between DFIs and multilateral banks like EIB, who have an impact mandate and rely and have been entrusted with a lot of capital from the governments, from the citizens of the countries, with the pension funds, which are managing on behalf of their members a lot of funds. It has to be a collective effort. One thing I think which could be done more, but we already see it, is that we need to share risk. So that's also a collective effort. So we need more insurances, more guarantees. We see the European Union has, taken a big step, allocating 13 billion euros to provide guarantees to help mobilize private investors and other investors into the emerging and developing markets. EIB has worked with this for a long time. We are also entering this business to try and do our small bit from where we are to continue that track. But sovereign governments, strong, rich, empowered people and governments and pension funds needs to see what they can to share more risk so that we can help develop and help achieve the goals of the climate agreement in Paris and also the SDGs. Thank you.
Thank you. We seem to be running out of time. Only I'm extremely intrigued now about Greg, if you can share some numbers, like because what Morten mentioned is very clear about shared risk. That's also what you are speaking about. I think that's one of the angles of why you are planning to consolidate. But can you share some numbers about how much is the Swiss pension funds investing, or you see going ahead invest in impact investment?
Well, difficult at this stage to give clear numbers. I think I'm so optimistic because I see impact investing. I think this industry, this trend is going to last for the next 50 years. If you look at just to give you an image of the set of opportunities, if you classify the sectors of the economy, you have the sectors in transition, the sectors phasing out, the all green and the fourth industrial revolution. In the long run, those two buckets will converge into two. So that shows you how much opportunities we are having ahead of us. One of the biggest constraints for pension funds is to have a proper diversified portfolio. And that's the reason why we have at this stage to team up with big players. And the government is a clear solution, in my opinion.
Thank you so very much, all of you. Please, Nicolette, you take it over.
Thank you. Thank you so much. I hope the discussions gave you perspective and hope for the future. We heard a lot, and I think the word engagement came the most. We heard barriers, but also solutions. We see that there are actors going faster, others going slower, but as Madam Badiola mentioned, we go on the right direction. And I think for the moment it's already a good statement. Let's keep the pace. And we hope to see you next year with results going to 5% or 10%. The highest, the better. The largest the market, the largest for everyone. In fact, that's the point, I think. And there is also risks are shared in a different way. So we have all an interest to really extend this market. Thank you so much. Do not hesitate to contact us, Swiss Impact Investing Association. You will see more information on our website. And thank you again for your time and participation. Thank you to all speakers.